Today, we're diving into a slightly different but equally important area of investing, bonds. Bonds may not be as flashy as stocks, but they play a crucial role in a well-rounded portfolio. So let's unpack what bonds are, the different classes available, how to own them, when to buy them, and whether they deserve a spot in your dividend growth portfolio. By the end of this video, you'll have a clear understanding of the role bonds can play in your investment strategy and whether they align with your goals for dividend growth. Welcome back to Dividend Stockpile, the channel where we help you build a rock-solid portfolio with a focus on growing your passive income. I am an income investor with over 25 years of experience. So what exactly are bonds? Bonds are essentially loans that you, as an investor, give to governments, municipalities, or corporations. In return, they pay you regular interest payments, known as coupon payments, and return your principal at the end of the specified terms. Think of a bond as a way for entities to raise funds without giving up equity. For example, if a company needs money for a new project, instead of issuing new stock, which dilutes ownership, they might issue bonds. Investors who buy these bonds are essentially lending money to the company, and in return, the company agrees to pay them interest over a set period. The length of time until a bond's principal is repaid is called the maturity. Bonds can have short-term maturities of just a few months, or long-term maturities extending up to 30 years or more. The key characteristics of bonds include the face value, also known as par value. This is the amount you'll get back when the bond matures. Coupon rate, the interest rate the bond issuer will pay you, usually annually or semi-annually. Maturity date, the date when the bond's principal is due to be repaid. And the issuer, the entity issuing the bond, which can be a government, municipality, or corporation. Bonds are generally considered less risky than stocks because they provide predictable income and repayment of principal, but that doesn't mean they're risk-free. Factors like interest rate changes, credit risk, and inflation can impact their performance. There are different types of bonds that you can invest in. The first up is government bonds. These are issued by national governments and are generally considered the safest type of bonds. In the United States, for example, Treasury bonds, or T-bonds, are backed by the full faith and credit of the United States government. This category also includes Treasury notes, or T-notes, and Treasury bills, T-bills, which have shorter maturities. Next, we have municipal bonds. Municipal bonds, or munis, are issued by state or local governments to fund public projects like schools, highways, and hospitals. The interest earned on municipal bonds is often exempt from federal taxes, and in some cases, state and local taxes as well, making them an attractive option for investors in high tax brackets. Next, we have corporate bonds. Corporate bonds are issued by companies to raise capital for various purposes. These can be higher yielding than government bonds, but they also come with more risk, especially if the issuing company has a lower credit rating. High yield bonds, also known as junk bonds, these are issued by companies with lower credit ratings. They offer higher interest payments to compensate for the increased risk of default. While they can be lucrative, they're also much riskier, so they require careful consideration. Next, we have inflation-protected bonds. So Treasury inflation-protected securities, or TIPS, are a special type of U.S. Treasury bond that adjusts its principal value according to inflation. This can be a good option for investors looking to protect their purchasing power over time. And finally, we have foreign bonds. These are bonds issued by foreign governments or companies. They can add an element of diversification to your portfolio, but they also come with currency risk, as fluctuations in interest rates can affect your returns. Now let's talk about how to own bonds. There's a couple different ways you can do it. You can do it by individual bonds, and this is the most direct way to invest in bonds by purchasing them individually. You can buy them through a broker or directly from the issuer. This allows you to select bonds that match your specific criteria in terms of maturity, credit quality, and yield. Here are some recent bonds that are issued for your viewing pleasure. Next, we have bond funds. Bond funds, such as mutual funds or ETFs, pool money from many investors to buy a diversified portfolio of bonds. This is a more convenient way to invest in bonds, especially if you're looking for diversification and professional management. On the screen here, you can see a couple of the more popular bond funds. Next, we have bond ETFs. Bond ETFs are traded on stock exchanges like individual stocks, allowing for intraday trading and liquidity. Mutual funds, on the other hand, are priced only at the end of the trading day. Both options offer diversification, but ETFs typically have lower fees. There are passive bond ETFs like AGG, the iShares Core US Aggregate Bond ETF, or actively managed ones like BINC, the BlackRock Flexible Income ETF. You can also take a laddering strategy, which is a strategy for managing bond investments where you buy bonds with different maturities. As shorter bonds mature, you reinvest the proceeds into new bonds. This helps manage interest rate risk and provides a steady stream of income. Now, when is it the best time to purchase bonds? A couple things to think about. The first is the interest rate environment. The best time to buy bonds is often dictated by the interest rate environment. When interest rates are high, newly issued bonds offer better yields. However, when rates are low, existing bonds with higher coupons become more valuable. Bonds tend to perform well during economic downturns where investors seek safety. In a recessionary environment, bonds, especially government bonds, are often seen as a safe haven compared to stocks. The yield curve, which plots bond yields against their maturities, can provide insights into the best times to buy. A steep yield curve suggests longer-term bonds offer higher yields, while an inverted yield curve can be a sign of economic trouble ahead. Ultimately, your personal financial goals and timeline should also guide your bond purchases. For example, if you're approaching retirement and looking for stability, bonds can provide a steady income stream with lower risk. Now, let's talk about if bonds are a suitable addition to a dividend growth portfolio. First thing to consider is the balancing growth and stability. Bonds are often seen as a way to balance the higher growth potential of stocks with the stability of fixed income. While dividend stocks offer income and potential capital appreciation, bonds provide a more predictable return, which can be appealing during volatile market periods. Adding bonds to a dividend growth portfolio can enhance diversification. This can help reduce overall portfolio risk, as bonds often perform well when stocks are underperforming. For investors focused on income, bonds can provide a more stable cash flow compared to dividends, which can be cut if a company faces financial difficulties. This can be particularly important for retirees or for those nearing retirement. However, bonds are not without risks. Interest rate risk, credit risk, and inflation risk can all affect bond performance. It's important to weigh these risks against the stability and income they provide. For most dividend growth investors, a small allocation to bonds, perhaps 10 to 20% of the portfolio, can provide a buffer against market volatility without sacrificing too much growth potential. This can be particularly useful during periods of economic uncertainty. In summary, bonds can play a valuable role in a well-rounded investment strategy, providing stability and diversification. Whether or not they belong in your dividend growth portfolio depends on your individual goals, risk tolerance, and market outlook. If you found this video helpful, please make sure to like, share, and subscribe to Dividend Stockpile for more insights on building a portfolio that stands the test of time. Leave a comment below and let us know if you're considering adding bonds to your portfolio. Thanks for watching, and as always, happy investing and keep on building your dividend stockpile.